Hi, everyone. Thank you so much for joining our webinar today on the big, beautiful bill. We have got a lot of great information to dive into. It's going to be a lot of information. We are recording this webinar and we will send you the recording as well as the PowerPoint presentation when everything is over. But also, please, we will have contact information at the end. Feel free to reach out. I will also send an email to you after the fact if you need to or want to schedule any additional meetings or one-on-ones or anything about anything that we touch on here. Please do so. We would love to help in any way that we can. Also, we will be opening the floor for questions at the end of the webinar. You will see a chat box in this presentation. Please feel free to type your question into the chat box at any point in time. And we will read it at the end. We will address everything, but we don't want you to forget your question. So go ahead and type it in as you think of it, and we will get to it. So, yeah, I just touched on all of this, but we're going to focus on a lot of changes that are impacting you, whether you are an individual, a business owner, both. We've got some retirement plan information. And we just want everyone to have a better understanding of how this may affect you now or in the years to come. On the screen now, you will see beautiful pictures of our 4 presenters today. Ed Saney is our managing partner. Colin Whedon is one of our senior accountants, and we'll be touching on individual and some retirement information. Bill Friedman is a senior tax manager and audit manager with the firm. He will be diving into a lot of various information covering a lot of businesses and the manufacturing updates that this bill has. And Sam Schubach is our senior accountant as well, touching on a lot of corporate information, high net worth information, some PTET, and some other topics. So I will kick this over to Ed Saney to get us started, and I will look for your questions at the end.
Hello, everybody, and welcome to the One Big Beautiful Bill Act, which is signed into law on July 25 of this year, and nothing major yet, but constantly being modified. So it's going to be in and out probably for the next 15 months that they're going to be making changes to it. But we're going to give you an update of everything, and the impact is definitely going to be on all the individual and business taxes and the high income taxpayers. The TCJA was the previous tax act brought in by Trump in 2017. Many of those provisions were expiring this year, and they've been made permanent. And along with that, there's new business incentives and rules and changes affecting the corporate tax rates, the pass-through entities, and taxes on the high net worth individuals on limitations mainly. So hopefully we're going to be able to understand these provisions. There's a lot in these slides, and as Morgan mentioned, you're going to be getting a copy of these, and it'll be very useful to you. I'd like to now turn it over to Colin to get into the overview. Thank you.
All right. Good morning, everyone. Thanks for jumping on here. I'm just going to go through some of the permanent and temporary individual taxpayer changes that went into effect with the passing of this bill on July 4th. So looking at some of the permanent changes, starting with the income tax brackets, there was actually 7 tax brackets that were created by the Tax Cuts and Jobs Act, and they've all been made permanent. These 7 tax brackets vary from 10% all the way up to 37%, and obviously that's all depending on your taxable income and your filing status, whether you're single, married, filing, joint. More permanent changes to the standard deductions. Permanent extension of the previously increased amounts for 2025 for single filers or married filing separate. The deduction is $15,750. That's actually a $750 increase from the original 2025 amount that was going to be $15,000. Married filing joint is at $31,500 this year. That's a $1,500 increase from the original 2025 amount of $30,000. And head of household is at $23,625, which is about an $1,100 increase from what the original amount was going to be. Looking at personal exemptions, these were originally suspended with the Tax Cuts and Jobs Act in 2017. And then the One Big Beautiful Bill actually permanently eliminated them. And to kind of offset the elimination of these personal exemptions, there's increases in the standard deduction. So that's kind of what they're doing to offset eliminating those. Child tax credit, this increased up to $2,200 per eligible child. The old rate was about $2,000, I believe. And the credit amount is also adjustable for inflation starting in 2026. This credit is also refundable up to $1,700 for 2025. This is basically aimed to benefit those who may have lower incomes and don't owe as much tax, and might not be able to receive the full credit. So they're going to refund some of that if you're, maybe a lower income family and, don't have as big as a tax liability. There's also a new eligibility rule on the child tax credit. If you're filing joint, the taxpayer and the spouse, along with the child, all must have valid Social Security numbers in order to claim that credit. Looking at estate and gift tax exemptions, there's an increase to the exemption to $15 million per individual and $30 million for married couples. And there was also the elimination of the sunset provision that was in the Tax Cuts and Jobs Act, which basically would have lowered the exemption to $7 million per person starting in 2026. So this, the One Big Beautiful Bill basically increased the exemption and prevented it from being lowered starting at the end of the year. Itemized deductions. Taxpayers who do not itemize can actually now claim a deduction for any cash contributions up to $1,000 if you are a single filer, $2,000 for married filing joint. Also makes permanent the deduction of up to 60% of the taxpayer's adjusted gross income for charitable contributions. And there's, we'll talk about this in one of the later slides, but there's also an increase in the state and local tax deduction limit that went up from $10,000 to $40,000, and is going to revert back to $10,000 starting in 2030. And the mortgage interest deduction has been limited to the interest you pay on the debt of your mortgage up to $750,000. Moving down to some temporary changes. This one actually could be pretty beneficial if you're a senior, 65 and older. There's actually 2 additional deductions. The first one is $2,000 if you're a single filer and you're 65 or older and or blind. And it's $1,600 each for married filing joint filers, so $3,200 total if you're both over 65 and or blind. And that just adds right onto your standard deduction. And there's also another bonus deduction if you're 65 and older of $6,000. So if you're a single filer, 65 or older, you get a bonus deduction of $6,000. So $12,000 if you're both 65 filing joint married. So basically, if you're 65 and older, your total standard deduction for single filers can be up to $23,750, which is your normal standard deduction plus that $2,000 additional and $6,000. And then married filing joint seniors, their standard deduction can actually increase up to $46,700. So you're getting that $31,500 standard deduction plus the $3,200 and the additional $12,000. So this is kind of some good deductions if you're 65 and older, hopefully save you a bunch of money on your returns. And then obviously these bonus deductions start to phase out as your income gets higher. For single filers, your adjusted gross income, it starts to phase out if you're over 75,000, and it fully phased out at 175,000. And if you're married filing joint, the deduction starts to phase out when your income is over 150,000, and it's completely phased out at 250,000.
You might want to just add in there, Colin, that's the $6,000 you hear about on where you think or you're hearing that Social Security exemption for the taxpayers.
Yep. In the tip income deduction, this is a deduction that can reduce your taxable income by up to $25,000. This also begins to phase out depending on your income. Single, it starts to phase out at 150,000. Married filing joint, 300. And this deduction will only apply to your tips that are reported and reflected on your W-2. There's also overtime pay deduction. I know we're going to touch about that in a few slides, so I'll save that for a few minutes. Auto loan interest. This is a deduction up to $10,000 per year for the interest paid on any new auto loans for qualifying vehicles you purchased between 2025 and 2028. And there's to be eligible for this, the vehicle must be new, used for personal use, and have final assembly in the U.S. And that, again, like all the other ones, this is also subject to phase out depending on your income. And then a key other changes, there's new things called Trump accounts. This is basically just a savings account for all children born in 2025 through 2028 with valid Social Security numbers. Basically, any parents that file their tax return in 2025 to 2028, they will be automatically set up. These accounts automatically get set up for their children. But if you don't want them, you actually have to opt out. But when they get set up, the federal government puts in a one-time $1,000 deposit into the account, and it has a $5,000 contribution limit per year. Employees can contribute up to $2,500 per year, and that counts towards your annual $5,000 limit. There's also no withdrawals may be made before January 1st of the year the child turns 18. And then after January 1st of the year the child will be turning 18, the account is basically just treated with typical IRA rules. Withdrawals can be made for early deductions. Otherwise, they face that 10% penalty for early distributions. And then the last one, some third-party payment reporting. Form 1099-Ks. I'm not sure how many people on here get issued these, but if you do, you won't be issued one unless you receive over $20,000 in gross payments and do over 200 transactions during the calendar year. I will kick this over to Sam for our next slide. Oh, and then actually I got retirement and investment too, sorry. 2025, your 401k contribution limit is $23,500. And if you're over 50, you can put in an additional $7,500. And if you're actually 60 to 63, you can increase your catch-up contributions up to $11,250. There's also some capital gains and dividend treatment. Higher income investors may pay less than before, depending on bracket movement. And there's some planning opportunities, such as a backdoor Roth IRA, that are still allowed for now. So it might be smart to leverage those while they're available. And there's some more favorable Roth conversion windows before RMDs begin at 75. So now I'll kick it over to Sam.
Thanks, Colin. I'm going to go through some of the corporate and high-income individual impacts of the Big Beautiful Bill. So to start off, corporate tax rate, there's no change in the statutory corporate tax rate. The federal corporate income tax rate will remain at 21%, which is unchanged from the rate set by the 2017 Tax Cuts and Jobs Act. The One Big Beautiful Bill made the QBI deduction, the qualified business income deduction, permanent and expanded its phase-in range, making it more accessible and beneficial for those pass-through business owners that we have on today. It also reinstated 100% bonus depreciation and made it permanent. Without the passing of the bill, bonus depreciation for 2025 would have actually been reduced to 40%, but now corporations can permanently deduct full costs of qualifying short-lived investments such as machinery and equipment in the year in which it is placed into service. This pretty much just accelerates your tax savings for the immediate expensing of R&D costs. So the bill repealed the 5-year amortization rule for domestic research and development expenses, allowing businesses to deduct R&D costs immediately. Now for some of the high income individual impacts, Colin kind of already touched on the federal gift, estate, and GST tax exemptions, but for individual income rates, the bill made the Tax Cuts and Jobs Act of 2017 reduce rates permanent. It also introduced new itemized deduction caps for high earners. So the bill reduces itemized deductions for individuals earning over $500,000 with gradual phase out that limits the benefit of deductions such as mortgage interest and medical expenses. For charitable contribution deductions, the bill enhanced charitable deduction rules, allowing more taxpayers to itemize and claim contributions. The bill also raised the AGI limits for cash contributions to qualified charities. Then moving down to AMT, or alternative minimum tax, the alternative minimum tax exemption amounts were increased and made permanent, reducing the number of taxpayers subject to AMT. A big one that we're probably going to touch on even later in this presentation is the SALT deduction, which is also the state and local taxes deduction cap. So the bill has increased the $10,000 cap to $40,000. This will allow many of you with higher real estate taxes on your primary homes to get a bigger deduction, and may allow those who typically take the standard deduction to itemize in 25. As we move along here, this slide is a list of all the topics included in the bill that will impact business owners, and we actually have slides for all of these topics going forward in the presentation. So now we're actually going to hand it over to Bill Friedman and Ed Thaney to discuss these items listed here further.
The new bill introduced a new section 168.9, which is for qualified production property, such as manufacturing facilities, that will allow a 100% write-off for new construction between January 19th of 2025 through January 1st of 2021. This expands basically the 100% bonus depreciation that you would have otherwise been limited, through like cost seg. We would have allocated certain things to 15-year, 7-year, and 5-year property. Now that 39-year property will be able to be expensed. This will exclude, though, offices, administrative service areas, parking, garages, research and development, and engineering. And then there are some non-qualifying production activities. There'll probably be a lot of interpretations that'll come out as to certain use space that are part of that manufacturing or production facility. And as we were saying, is that they've also reinstated the bonus depreciation to 100% and has expanded the 179 expensing increasing the limits from $1,250,000 to $2.5 million, and raised the phase-out threshold from 3.1 to 4 million, and then it's fully phase-out applies at 6.5 million. There's a lot of considerations to take in for the manufacturers, and I think 179 offers a lot of flexibility in tax planning. The changes on the R&D expense side, I mean, in the prior R&D had to be amortized over 5 years and foreign over 15. This now will allow taxpayers to write off any unamortized costs in 2025 and spread the deduction over 25 and 26. And it'll allow immediate deduction for domestic R&D. Foreign R&D will still be continued to be amortized over 15 years. Moving on to the interest expense limitations. This was really made permanent now, but they've adjusted the base by allowing you to add back depreciation and amortization and depletion when computing the alternative taxable income. The deduction then is limited to 30% of that new base. This is going to be highly beneficial for manufacturers with high depreciation and amortization on machinery and production facilities, and it'll takes effect permanently after December 31, 24. There were a bunch of changes in the international tax space, which I think affects that many of our clients, but there's been a lot of renaming and redefinition of the exemptions under those rules and the expense allocations. The corporate tax rates were no changes. It was set at 21%, and the qualified business income deduction has been made permanent now at 20%. These were set to expire at the end of 25.
All right. So circling back into these could be some personal changes to the overtime pay and 1099s you may receive. Starting with overtime, there's a new deduction up to $12,500 for single filers and $25,000 for joint. This is basically a deduction on the premium portion of your overtime pay. It can get a little confusing. So basically, if you're making $20 an hour and then you're getting time and a half for overtime, your new $30 rate for overtime, you only can deduct that additional $10 you're making for each hour of overtime. So it's not all of your overtime wages. It's only that extra half of your time and a half you're getting, if that makes sense. And again, similar to all the other.
On that item, though, that there's probably going to be some subsequent guidance issued, because that's the position that the Internal Revenue Service is taking right now, and there'll be whether or not that was actually the intention of Congress, that it would only limit it, or whether it was any overtime over the standard work week.
And then, yeah, similar to all the other deductions, obviously these are going to phase out depending on your income levels. And then looking at the 1099s, little threshold change, 1099 miscellaneous and the NECs used to be getting them if it was $600 or more, and they are changing that to $2,000. But that's not going to start until 2026. The bill introduced a lot of simplified accounting methods for
residential homeowner constructions. It would be effective for 26, and it basically would allow short-term projects to be recognized under the completed contract method, where usually it had to be done under a percentage of completion method. This should simplify things for some of the small builders and small contractors. And it'll be effective for multi-family housing, student housing, condominium projects, and projects that extend 2 to 3 years under the small contractor exceptions, rather. It'll allow you to defer income, improve cash flow. There were some changes to qualified small business stock for those C Corp, non-corporate taxpayers. They increased the exclusion if you've held it for 3 to 4 years to 50%, 4 to 5 years, 75%, and 100% exclusion that's held more than 5 years. Those eligible issuers, they've also increased the gross asset limit from 50 million to 75 million, and it applies to stock issued now after July 4th, 2025 for those increased limits. It's also going to be indexed for inflation going forward in 26 and beyond. And the per issuer cap was also increased from 10 million to 15 million.
Now, for a little bit more on PTET, or the pass-through entity tax election. So the One Big Beautiful Bill actually made no changes to the PTET tax credit provisions, meaning that the state level SALT cap workarounds still remain intact. As a result, many of you with pass-through entities may still benefit from making PTET elections, despite the expansion of the federal Schedule A SALT deduction cap up to $40,000. And then that'll bring us to QBI. So the One Big Beautiful Bill permanently extended the 20% qualified business income deduction for qualified entities under Section 199A. The QBI deduction was previously set to expire at the end of 2025, but the Big Beautiful Bill extended that and made it permanent. This deduction allows non-corporate taxpayers, such as owners of partnerships, S corporations, and sole proprietorships, to deduct up to 20% of their qualified business income, which is subject to certain limitations. Because the Act does not modify federal income tax rates, the QBI deduction continues to reduce the effective top marginal rate of 37% to about 29.6% on qualifying income. Additionally, the Act introduces more favorable thresholds for the phase-in of various QBI limitations. However, it also includes a new restriction that disallows the deduction if the calculated QBI benefit is less than $400 in any year, with this minimal threshold indexed for inflation. And now we're going to go over to Ed on enhancement of employer-provided child care credits.
Thanks, Sam. Yeah, this provision permanently enhances the employer-provided child care credit effective 1/1/26. And it's for qualified child care expenses is increased from 25% to 40%. And it's eligible for small businesses meeting a $31 million requirement, gross receipts, or $600,000 a year. The test is updated from 3 to 5 years, and it allows the small businesses to pool the resources to use to a third-party intermediary to provide child care services. So if you're an employer providing child care services, this credit should apply to you as long as your gross receipts are less than $31 million a year. And then with the employee retention credit, everybody remembers that from yesteryear in COVID, getting some refunds from that. I'm not sure if any of you still are due refunds from them or forgot about the refunds from them, but they were all held up because there was a bunch of fraudulent returns being filed. And these are the new enforcement provisions they're putting onto it. And they're increasing the penalties. They're doing a due diligence requirements, and they're restricting a lot of refund claims. However, what we just heard is that they are done with all their audits of the targeted companies that they were after. So we are now rekindling that with the IRS and pursuing some claims that were held up. But if you have not gotten any notices as of yet of being checked for those ERCs that you may have not found, they're telling us, not formally, that they're done with the audits. So they're extending the statute of limitations on it, but we do believe that their major audit for the fraudulent returns that have been filed has ended. And then the excess business losses, if unfortunately you've had net operating losses on the corporations, for the taxpayers, any pass-through that's from them or pass-through entities, if you have an NOL, is now $500,000 limit is now permanent, so you're limited to $500,000 a year. They offset up to 80% of taxable income in future years. And if you have excess of $500,000, those amounts are carried forward to future years, but will be limited only to 80% of the taxable income. And again, we've been talking about the SALT deduction. It's temporarily raising this from 25 through 29, from 10,000 to 40,000. It phases down to 10,000 if you're over a modified adjusted gross income of $500,000, and it does not affect the PT pass-through entity tax deduction. So if you all know that the pass-through entity tax can come through the corporation and is not going to be attributable to the $40,000. Qualified opportunity zones. The incentives remain now through 26. New permanent ones are going to be starting in 27. They're going to be restricting some of the types of properties, but if you qualified opportunity zone is designated usually low income areas where they want some kind of revitalization. It was again brought into the effect in 2017 under the TCJA, and it's worked pretty good. But I think some of the zones when they originally did it were pretty broad and in very nice, some of them were in nice areas. But you get an incentive of deferral of real estate taxes for up to a 5-year period, and depending on how long you own the property, the capital gains on it once you sell it, the appreciation would be excluded, and you'd have basically no taxable income on it on the sale. There would be no capital gains on these businesses. So they're going to have new reporting requirements, but I think the penalties were basically self-inflicted by the IRS when they made these laws, and it's going to be more revised. So there's again any kind of new tax law people take advantage of, and once it hits over 20% of the people taking advantage, penalties show up. But if you have any concerns about acquiring property. Every city's got a qualified opportunity zone, so check those areas. You can find out through the IRS or give us a call on them if you're going to be doing anything like that. And again, what we're doing, with our year end for our firm here, we're doing a lot of planning. We start a tax planning season right around October 1, but many clients even want to start it earlier than then. We always remind our clients that on January 1, we become historians and we can't do anything else about that year. So that's why we are giving you these seminars or webinars this time of the year to be able to plan and to give us a call on it. I know a couple other things on that too, important things or good things that the government has done and expanded. Keep in mind, if you're in a blue state like New York, some of the tax changes are not affecting us, like the estate tax. It's increased from 15 million to 30 million, which is great for for the high income individuals. But New York State has a limitation of 7 million. So you would be, subject to an attack, if you're worth $14 million and you pass in New York State, you would be subject to an estate tax of $8 million. So keep that in mind. Give us a call for anything else. And thank you very much.
All right, so I'd like to open the floor for some questions now. We've got a couple so far. If anyone has any others, like I said, please pop them in the chat box and we'll get to them. All right, so first question. I don't understand, if I am in the 37% tax bracket, why are my deductions capped at 35%?
Okay, I can maybe do that one. You're talking about the itemized deductions, I would assume, and it's capped at 35. You can't go past 35. I think the range of a 35% tax bracket, let's say for a joint return, is $225,000 to $625,000. So in that range is 35%. After $625,000, it's 37%. So what I believe they're saying is that if I have $630,000 of taxable income and I have a $500,000 charitable contribution, that would put me down to 135. And they're saying you can't go down that many brackets. You can only go down to the 35% bracket. So it wouldn't be worth it to do that if you get below that 225,000, because it's going to be taxed at the higher 35% rate for those, anything going into there. Hope that helps.
All right, thank you. Next question. If I own my own business and I am paying PTET, can that state deduction for over the $40,000 SALT cap be taken into consideration?
Yes, I mentioned that, probably explained it the wrong way. The PTET deduction, if you're doing it, you're paying it through your entity. So it's your corporate S corporation, pass-through entity, or a partnership, pass-through entity. You're paying those PTET, and we're taking it as a deduction on that entity. So it really doesn't go over to your personal return, except as a lower taxable income for the federal government. There's an adjustment on your personal return for that on the state, and the state taxes are still added back on your state return for taxable income anyhow, wherever it comes from.
Okay, that seems to be it for our questions. Guess you guys really explained everything pretty well. So in closing, I will, as I mentioned, I'll send this out to everybody so you've got contact information, but as Ed said, we are getting our tax planning meeting started and scheduled. And we've got one more question that just popped up, sorry. Please review the difference between adjusted gross income and modified adjusted gross income.
Okay. Bill, you got that? Do you want to do that, or?
Sure.
When they're talking about, I believe what this is when they're talking about modified gross income, it takes your AGI and adds back or reduces things that are going to be in play with that. Similar to Social Security being added back or reduced and getting to an adjusted gross income to determine if your adjusted gross income, to determine if your Social Security is going to be taxable to you. What was it on the other things there, Bill, that you had?
The modified adjusted gross income.
Yep.
Is just, it takes further modifications, adding back certain deductions, you know, for specific tax credits or benefits.
And I think some of those things have to do with bonus depreciation, things like that, where it gets to a higher modified
or
income.
Like,
or
right. Well, like some certain items, like for the modified, like the premium tax credit, or you know, under the American Opportunity Tax Credit, the child tax credit, retirement contributions, examples like that. Other items that get added back to AGI to calculate the MAGA is, you know, like the student loan interest, IRA contributions, tax-exempt interest, non-taxable security benefits. So it's used in the modified is used in certain calculations.
Correct. Thank you.
Thank you both. Hopefully that answered your question. Okay, so as I mentioned again, I will be sending this out to everyone. We'd love to get your tax planning meeting scheduled. We've got a couple folks on here that are not clients of ours yet. We'd love to meet with you and have a consultation with you and see how we can help you. So we'll be reaching out directly after this, and I will be sending all of this information. So if you had a question and it comes up later or you forget, please, you know, respond, reach out directly. We can answer it. Otherwise, we really appreciate everyone taking time today to join us and hear about all these lovely changes. And we will speak with you all soon and hope you have a great rest of your day.
Thank you.
Thank you, Al.
Thanks, everyone.